Internal auditor, being known as the financial watchdog, spearhead the internal audit activity as it is in the third line of defense of an organization. As defined by the IIA, internal auditing is an independent, objective assurance and consulting activity designed to add value and improve an organization's operations by bringing a systematic, disciplined approach to evaluate and improve the effectiveness of risk management, governance, control, and processes. According to the international standards for the professional practice of internal auditing, internal audit activity must be consistent with its mission to enhance and protect organizational value by providing risk-based and objective assurance, advice, and insight, and with its mandatory guidance in the Internal Audit Charter. The IIA's implementation standards define two types of internal audit engagement, namely assurance and consulting services. Assurance services involve the internal auditor's objective assessment of evidence to provide opinions or conclusions regarding an entity, operation, function, process, system, or other subject matters. Its nature and scope are determined by the internal auditor. On the other hand, consulting services are advisory in nature and generally performed at the specific request and agreement with the engagement client. Internal auditing is also governed by principles and expectations to be more acceptable and reasonable to implement in every entity. The Institute of Internal Auditors Code of Ethics aims to promote an ethical culture in internal auditing by conforming to principles of integrity, objectivity, confidentiality, and competency. At the same time, the internal audit activity is periodically assessed through the Quality and Assurance and Improvement Program, which can be internal and external assessments. Internal audit activity contributes to the improvement of the organization's governance, risk management, and control processes through using a systematic, disciplined, and risk-based approach, and are enhanced when auditors are proactive and their evaluations offer new insights and consider future impact. Also, in evaluating the potential occurrence of fraud and managing fraud risk. And that's all for Module 1. Hope you learned something today. See you on the next module.
In this video, we will talk about conceptual framework of corporate governance. Corporate governance is intended to help build an environment of trust, transparency, and accountability needed to foster long-term investment, financial stability, and business integrity, thereby supporting stronger growth and more inclusive societies. By definition, corporate governance means to steer an organization. Governance comes from the Latin word gubernare, which means to steer. Corporate governance refers to the way a company is being governed. However, the concept of corporate governance is defined in several ways because it covers a whole range of activities. In the simplest sense, corporate governance is an organization's roadmap so as to maximize the wealth of shareholders and protect the interests of stakeholders. Corporate governance best fits an organization where the following are present. First, separation of ownership and control. Second, stakeholders who have legitimate interest in the organization. And third, underlying principles of corporate governance. In response to the problems arising from the corporate structure, which separates ownership and control, corporate governance has partly developed. Structure follows the strategy. For example, the way the organization is structured defines its power over transactions under transaction cost theory. The strategy also sets the legal structure of an organization. Such legal structure, in turn, sets the framework and governing rules under which it operates. Sole proprietorship is a type of business organization which an individual personally owns a business. It has no distinct personality from the owner. Thus, the owner is responsible for all debts and obligations. Partnership is formed when two or more persons band themselves to contribute money, property, or industry to a common fund with the intention of dividing the profits and ownership among themselves. It has a separate legal entity from the partners but has unlimited liability. Corporation is a legal entity with a personality distinct and separate from the owners or shareholders. There is also a limited liability. In finance theory, the basic assumption is that the primary objective for companies is shareholders' wealth maximization. Transactions cost theory considers that managers' decisions are limited by the understanding of alternatives that they have, that managers are opportunistic, that they will organize their transactions to pursue their own convenience. Stakeholders are persons or groups that have a legitimate interest in a business conduct and whose concerns should be addressed as a matter of principle. A stakeholder can be anyone who has any type of stake in a business. There are several ways to classify stakeholders, such as by proximity, legitimacy, claims, voice, how much affected, how much affects, degree of participation, engagement, and public knowledge. Stockholder theory argues that shareholders own the company. Under stakeholder theory, management has a duty of care, not just to the owners of the company in terms of maximizing shareholder value, but also to the wider community of interest. Underlying principle of corporate governance. Effective corporate governance allows businesses to enjoy the full benefits of foreign and local capital markets, boost trust among investors, rising capital costs, and encourage reliable funding sources. There is no one-size-fits-all corporate governance structure. Rather, it needs to be principle-based to give a company some degree of flexibility in defining its own best practices depending on the age, scale, complexity. According to Teresita J. Herbosa, Chairperson of Securities and Exchange Commission, strong corporate governance is founded on the principles of fairness, accountability, and transparency. Fairness means equal treatment. This principle requires that everyone who has legitimate interest in the company must be taken into account and their rights and views be respected. Corporate accountability means acceptance of full responsibility for the powers and authority granted to those charged with governance and of obligation to explain one's action in carrying out its responsibility. Transparency means open and clear, timely and accurate disclosure of relevant information, financial or non-financial, to shareholders and other stakeholders, as well as not concealing material information. The G20 or OECD principles of corporate governance lay down the 6 building blocks for a sound corporate governance framework. Corporate governance is primarily about how the board manages the company. Shareholders, on the other hand, have the power to elect and remove directors when directors contravene their duties or act contrary to the principles, values, and ethics of the company. And while corporate governance is a flexible concept, it must always adhere to the principles consistent with the wide interest of stakeholders. Conceptual framework of corporate governance.
The SEC Code of Corporate Governance takes up 16 principles under 5 broad categories for publicly listed companies. The board's governance responsibilities, disclosure and transparency, internal control system and enterprise risk management framework, cultivating a synergistic relationship with shareholders and/or members, and duties to stakeholders. The board's governance responsibilities. Number 1. The company should be headed by a competent board to foster the long-term success of the corporation and to sustain its competitiveness and profitability in a manner consistent with its corporate objectives and the long-term best interests. Number 2, the fiduciary roles, responsibilities, and accountabilities of the board as provided under the law, the company's articles and bylaws, and other legal pronouncement and guidelines should be clearly made known to all directors, as well as to shareholders and other stakeholders. Number 3, board committee should be set up to the extent possible to support the effective performance of the board's functions, particularly with respect to audit, risk management, related party transactions, and other key corporate governance concerns such as nomination and remuneration. Number 4, the directors should devote the time and attention necessary to properly and effectively perform their duties and responsibilities, including sufficient time to be familiar with the corporation's business. Number 5, the board should endeavor to exercise an objective and independent judgment on all corporate affairs. Number 6, the best measure of the board's effectiveness is through an assessment process. There should be a regular evaluation to appraise its performance as a body and assess whether it possesses the right to mix of backgrounds and competencies. Number 7, members of the board are duty-bound to apply high ethical standards, taking into account the interests of all stakeholders. Disclosure and transparency. Number 8, the company should establish corporate disclosure policies and procedures that are practical and in accordance with best practices and regulatory expectations. Number 9, the company should establish standards for the appropriate selection of an external auditor and exercise effective oversight of the same strength, the external auditor's independence, and enhance audit quality. Number 10, the company should ensure that the material and reportable non-financial and sustainability issues are disclosed. Number 11, the company should maintain a comprehensive and cost-efficient communication channel for disseminating relevant information. This channel is crucial for informed decision-making by investors, stakeholders, and other interested users. Internal control system and risk management framework. Number 12, to ensure the integrity, transparency, and proper governance in the conduct of its affairs, the company should have a strong and effective internal control system and enterprise risk management framework. Cultivating a synergistic relationships with shareholders. Number 13, the company should treat all shareholders fairly and equitably, and also recognize, protect, and facilitate the exercise of their rights. Duties to stakeholders. Number 14, the rights of stakeholders established by law, by contractual relations, and through voluntary commitments must be respected, where if their rights and/or interests are at stake. Stakeholders should have the opportunity to obtain prompt, effective redress for the violation of their rights. Number 15, a mechanism for employee participation should be developed to create a symbiotic environment, realize the company's goals, and participate in its corporate governance processes. Number 16, the company should have socially responsible in all its dealings with communities, and it should ensure that its interactions serves its environment and stakeholders in a positive and progressive manner that is fully supportive of its comprehensive and balanced development. Good corporate governance allows company to reap the full benefits of international and local capital markets, improve investors' confidence, reduce cost of capital, and induce stable sources of financing. The G20 OECD Principles of Corporate Governance laid down 6 building blocks for sound corporate governance. Number 1. Ensuring the basis for an effective corporate governance framework. Number 2. The rights and equitable treatment of shareholders and key ownership functions. Number 3. Institutional investors, stock markets, and other intermediaries. Number 4. The role of stockholders in corporate governance. Number 5. Disclosure and transparency. And number 6. The responsibilities of the board. However, there is no one-size-fits-all framework of corporate governance. It must be principles-based to allow a company certain degree of flexibility in shaping its own best practices. According to Teresita J. Herbosa, Chairperson of Securities and Exchange Commission, strong corporate governance is founded on the principles of fairness, accountability, and transparency. Fairness means equal treatment, where it means that all shareholders should receive equal consideration by the directors and management with a sense of justice and avoidance of bias and vested interests. Responsibility, where the directors should carry out their duties with honesty, probity, and integrity. Corporate accountability means acceptance of full responsibility for the powers and authority granted to those charged with governance and be held accountable for one's decision and actions in carrying out its responsibilities. Transparency means open and clear, timely and accurate disclosure of relevant information, financial or non-financial, to shareholders and other stakeholders, as well as not concealing material information and why every material decision was made. Those charged with governance describes the role of persons entrusted with the supervision, control, and direction of an entity. They ordinarily are accountable for ensuring that the entity achieves its objectives, financial reporting, and reporting to interested parties. They are the persons with responsibility for overseeing the strategic direction of the entity and obligations related to the accountability of the entity. In some cases, those charged with governance are responsible for approving the entity's financial statements. Those charged with governance refers to those persons within the entity who are having the following 2 responsibilities. Number 1, accountability of the entity. And number 2, strategic direction of the entity. Management means such personnel who are responsible to perform day-to-day functions of the business and are also responsible for making financial statements. Board committees are appointed by the board to focus on specific areas and to take informed decisions within the framework of delegated authority and to make specific recommendations to the board on matters in their areas or purview. All decisions and recommendations of the committees are placed before the board for information on for approval. To enable better and more focused attention on the affairs of the corporation, the board delegates particular matters to the committees of the board set up for the purpose. Committees review items in great detail before it is placed before the board for its consideration. These committees prepare the groundwork for decision-making and report at the subsequent board meeting. Board committees normally function independently from each other and are provided with sufficient authority, resources, and assigned responsibilities in assisting the entire board.
Hi, I'm Uno, and I'm going to discuss the content of Module 4. Module 4 is composed of 3 topics, namely ethics, corporate social responsibility, and sustainability. The first topic is ethics. Ethics is rooted from the Greek word ethos, which means character, custom, habit, or disposition. It is a discipline on the well-founded understanding on what is right and wrong. This branch of philosophy is usually divided into 3 general subject areas. First is metaethics. Metaethics deals with the nature of moral judgment. It focuses on the issues of the universal truth, the will of God, the role of reason in ethical judgments, and the meaning of ethical terms themselves. Second is normative ethics. It is concerned with the content of moral judgments and the criteria of what is right or wrong. Lastly, descriptive ethics. It looks at controversial views about our moral beliefs. When the ethical principles and methods of analysis are applied to businesses, it is called business ethics. It is the study of the ethical dimensions of productive organizations and commercial activities. This includes ethical analysis of the production, distribution, marketing, sales, governance, and consumption of goods and services. Code of Business Conduct and Ethics ensures the proper and efficient implementation and monitoring of compliance to ethical standards. It also explains what behavior is expected of all employees and provides the standards that guide the work of the company. The second part is about corporate social responsibility. According to World Business Council for Sustainable Development, it is the continuing commitment by business to behave ethically and contribute to economic development while improving the quality of life of the workforce and their families as well as of the local community and society at large. It can also be defined as a voluntary initiative on the part of a business to contribute to a better society and to a greener and cleaner environment. CSR projects for businesses can be first, market-focused initiative. Second, product-focused initiative. Third, employee-focused initiative. Fourth, society-focused initiative. And lastly, environmental-focused initiative. Here are some examples of corporate social responsibility projects of some well-known companies. The first one is Jollibee. Jollibee has strawless policy every Friday to help conserve the environment. Another is from Lego Company. Lego replaced their plastic materials with plant-based plastics from sugar canes. Moreover, the benefits of CSR includes the following: increasing customer retention, saving money on energy and operating costs, differentiating yourself from the competitor, enhancing your influence in the industry and media interest and good reputation. The third topic is about sustainability. It is defined as development that meets the needs of the present without compromising the ability of future generations to meet their own needs. Its focus is about the availability of natural resources. There are 7 sustainability reporting principles listed as follows. Number 1. Materiality, which only include relevant topics. Number 2. Stakeholders inclusiveness is the relationship with the shareholders as to how and what extent the organization understand and respond to their needs and interests. Number 3. Balance means no bias. Number 4. Completeness. Consider extent of information disclosed and its level of specificity or preciseness. Number 5. Reliability is subject to audit training. Number 6. Accuracy means it must be sufficiently accurate and detailed for stakeholder to assess the corporate performance. And number 7. Consistency and comparability, which means it must be presented in a way that enables comparison to other corporations. How do we measure sustainability performance? Measuring sustainability performance is divided into two: the three pillars of sustainability and proper disclosure. The three pillars of sustainability are economic, environmental, and social. These pillars are also referred to as people, planet, and profits. Moreover, through proper disclosure, sustainability performance is measured in the way the corporation conducts its business and how it manages its key economic, environmental, and social impacts. And that ends my discussion. Again, I'm Uno. See you again next time. Bye!
One of the best ways to deeply understand and make the best decision for company's growth, it is very important to know the risks that a business might face and how to manage these risks. But first, let us know what a risk is. Risk is said to be a byproduct of setting objectives. It is the effect of uncertainty on objective, and it is also the probability of occurrence of harm and the severity of that harm. To simply put, risk is a deviation from expectations. It can be positive or negative. Risk is not the harm itself, but risk is the possibility that harm will occur, and what causes harm is hazard. However, risk does not always relate to harm, but it can also create opportunities. Uncertainty risk is not knowing the potential outcomes and the probability of these outcomes, while genuine uncertainty is when probabilities and potential outcomes are unknown. Now, let's go to the classification of risks. Risk can be classified based on its effect, controllability where it can be controllable or non-controllable, correlation where it can have positive or negative correlation, impact because risk can be financial or non-financial, and drivers because risk can be strategic or operational risk. There are four classifications of risk based on its effect. First is fundamental risk. These are risks that affect the society in general. Second is particular risk in which an individual may have some measure of control. Third is speculative risk in which either good or harm may result. And lastly is pure risk in which are those whose only possible outcome is harmful. The presence of risk also brings impact to the stakeholders. Shareholders may sell their shares resulting to a lower price. Creditors may deny credit, charge higher interest rate, file actions in the court that could lead the company into liquidation, and ask for a collateral. Since employees are concerned about threats to their job, there is a high chance that they will pursue their own goals rather than the shareholders' interests. Customers and suppliers will be scared to supply and buy goods from the company, and for the wider community, they will be more concerned whether the company will act as a good corporate citizen. These are the common risks faced by the company. First is business risk. These are simply the risks associated in doing the business. It is borne both by the firm's equity holders and providers of debt. Second is financial risk. It is related to the effect of the company's capital structure or the mix of debt capital. Third is market risk, which is another type of financial risk, but it is hardly controllable. Fourth is product risk, that is risk of financial loss due to the producing of poor quality product. Fifth is political risk, where a political action will affect the position and value of an organization. In addition, companies also face legal risk, technological risk, strategic and operational technological risk, environmental risk, probity risk, reputation risk, and fraud risk. To manage risk, companies should have an efficient risk management. It is a process to identify, assess, manage, and control potential events or situations to provide reasonable assurance regarding the achievement of the organization's objectives. The commonly used standards in managing risks include COSO 2017 Enterprise Risk Management Integrating with Strategy and Performance, COSO 2004 Enterprise Risk Management Integrated Framework, ISO 31000-2018 Risk Management Principles and Guidelines, a Risk Management Standard IRM or ALARM or AIRMIC 2002, developed in 2002 by the UK's three main risk organizations, and lastly is the Turnbull Guidance, to a need for principles-based guidance to help entities design and implement effective approaches to risk management. COSO issued the Enterprise Risk Management Integrated Framework in 2004. It defines ERM as a process effected by an entity's board of directors, management and other personnel, applied in strategy setting and across the enterprise, designed to identify potential events that may affect the entity and manage risk within its risk appetite to provide reasonable assurance regarding the achievement of entity objectives. This enterprise risk management framework is geared to achieving the entity's objective, set forth in four categories. First is strategic or high-level goals aligned with and supporting its mission. Second is operations, where it is the effective and efficient use of its resources. Third is the reporting or the reliability of reporting. And lastly is compliance with applicable laws and regulations. Enterprise risk management consists of 8 interrelated components. These are derived from the way management runs an enterprise and are integrated with the management process. These components are internal environment, in which encompasses the tone of an organization and sets the basis for how risk is viewed and addressed by an entity's people. Second is objective setting, where it is applied when management considers risks, strategy, in the setting of objectives. Third is event identification, where it differentiates risks and opportunities. Fourth is risk assessment, where risks are analyzed, considering likelihood and impact as a basis for determining how they should be managed. Fifth is risk response, where management selects with the entity's risk tolerances and risk appetite. Sixth is control activities, where policies and procedures are established and implemented to help ensure the risk responses are effectively carried out. Seventh is information and communication, where relevant is captured and communicated in a form and time frame that enable people to carry out their responsibilities. Eighth and last is the monitoring, which is accomplished through ongoing management activities, separate evaluations or board. Another standard that provides guidelines on managing risk faced by organizations is ISO 31000-2018. If COSO has 4 organizational objectives and 8 ERM components, ISO has 3 areas of guidance called principle, framework, and process. ISO believes that managing risk is based on these 3 areas. The principles are the foundation for managing risk and should be considered when establishing the organization's risk management framework and processes. ISO requires the following elements to have effective risk management. Integrated. Risk management is an integral part of all organizational activities. Structured and comprehensive. A structured and comprehensive approach to risk management contributes to consistent and comparable results. Customized. The risk management framework and process are customized and proportionate to the organization's external and internal context related to its objectives. Inclusive. Appropriate and timely involvement of stakeholders enables their knowledge, views, and perceptions to be considered. Dynamic. Risks can emerge, change, or disappear in an organization's external and internal context changes. Risk management anticipates, detects, acknowledges, and responds to those changes and events in an appropriate and timely manner. Best available information. The inputs to risk management are based on historical and current information as well as on future expectations. Information should be timely, clear, and available to relevant stakeholders. Human and cultural factors. Human behavior and culture significantly influence all aspects of risk management at each level and stage. Continual improvement. Risk management is continually improved through learning and experience. The purpose of the risk management framework is to assist the organization in integrating risk management into significant activities and functions. The effectiveness of risk management will depend on its integration into the governance of the organization, including decision making. Now, let's move on to the discussion of Chapter 6, entitled Enterprise Risk Management.